There is a quiet machine moving money through the market, and most people do not see it until after the move has already happened. That is how markets usually work. The movement begins under the surface. It is not announced by a headline. It is not explained clearly on television. It does not arrive as a simple message saying this is where capital is going next. It happens through flows. Money leaves one area, it enters another area. Prices begin to respond. The people watching only the broad index often miss the real story because they are looking at the average while the important action is happening inside the parts. Right now, in my view, that is the machine people need to understand. Capital is not simply sitting still in the same famous technology names that everyone talks about every day. It is rotating. It is moving out of crowded places and into areas that many ordinary investors have hardly studied. That does not mean every move will work. It does not mean a stock becomes good just because it belongs to an unpopular sector. But it does mean that if you only watch the names everyone already knows, you can miss the places where the probability is changing. And in markets, probability is what matters. A person who does not understand this can spend a year staring at the index, wondering why the market seems to be going sideways, while certain sectors quietly move in a very different direction. Another person who understands how to follow capital can see that the market is not one thing. It is a system of many different parts. Some parts are losing money flows, some parts are gaining money flows, and the job is not to guess perfectly, the job is to understand where the pressure is building. That is the difference between watching price and understanding movement. The first thing I would want people to understand is that the biggest stocks can keep getting bigger for reasons that have little to do with ordinary common sense. Most people think a stock goes up because people made a thoughtful decision to buy it. Sometimes that is true, but a lot of money today moves automatically. The S&P 500 is not an equal collection of 500 companies. It is weighted by market capitalization. That means the larger a company becomes, the larger its share of the index becomes. And when money flows into index funds, more of that money automatically goes into the largest companies. This creates a flywheel. The biggest companies receive the most automatic buying. That buying can help them become even bigger. Then, because they are bigger, they receive even more of the next dollar that enters the index. This is how a system can reinforce itself without most participants realizing what they are doing. It is not a conspiracy, it is mechanics. But mechanics matter. When a small investor buys an index fund, he may believe he is buying the broad American economy. In reality, a large portion of that money goes into a small number of very large companies. The source material points out that a very small group of the largest companies now makes up an unusually high portion of the index. That concentration matters because it changes what the investor actually owns. If the largest companies keep winning, the index can look very strong. But if those companies stop leading, even for a period of time, the broad index can disappoint while money does something else beneath the surface. This is why I do not like to look only at the headline number. A market index can hide as much as it reveals. If 10 companies are carrying a major part of the index, then you are not simply making a diversified bet in the way many people imagine. You are making a heavily concentrated bet that those dominant companies continue to attract flows. That may work for a while, it may work very well, but it also means you should understand the risk you are taking. Most people do not. They buy the average, they think they own safety. They believe simplicity has removed the need to think. But simplicity is not the same as understanding. Passive investing has grown because it is easy, cheap, and convenient. Those are real advantages. But every good tool has conditions under which it can become dangerous. If everyone is sending money through the same pipe, then the largest recipients of that pipe receive a powerful advantage. And if that pipe changes direction, the pressure can move quickly. That is why I think investors need to understand rotation. Markets are like weather systems. You do not need to predict every cloud. You do not need to know the exact temperature 3 months from now, but you do need to know whether you are standing in sunshine, wind, rain, or a storm. A person who refuses to look at the weather can be right for a while by accident, but over time the weather matters. The current weather is not the same as 2021. In 2021, many assets went up together. When liquidity was abundant and money was cheap, people could make careless decisions and mistake the result for skill. That happens in every cycle. A favorable environment makes many people look smarter than they are. Then the environment changes and reveals who had a process and who was just floating with the tide. Today, the environment is different. Inflation matters, interest rates matter, government spending matters, energy matters, geopolitical stress matters, supply chains matter, central bank decisions matter. The world is not giving investors a simple rising tide. It is giving them a set of cross currents. When the weather changes, different sectors need different clothing. That is a simple way to think about macro. You do not have to make macro complicated. You only have to ask what conditions exist and what kinds of businesses benefit or suffer under those conditions. If energy is scarce, the world behaves differently. If minerals are scarce, the world behaves differently. If interest rates stay higher than people hoped, capital behaves differently. If governments spend on energy security and domestic supply chains, certain industries receive a tailwind. This is not about being dramatic. It is about seeing cause and effect. One of the biggest mistakes many retail investors make is that they wake up, check the same news, look at the same index, and stare at the same mega-cap stocks. Everyone else is staring at. They ask what is moving today. They react to what is already obvious. But educated money does not usually sit in one place forever. It rotates, it moves from expensive to cheap, from crowded to uncrowded, from popular trades to neglected areas, from one sector to another as the conditions change. It may move from technology to energy, from mega caps to beaten down sectors, from long duration growth to businesses connected to real assets, infrastructure, defense, minerals, or other areas that benefit from the current weather. The important thing is not to worship any one sector. The important thing is to follow the money. That phrase is simple, but it contains a very important principle. You do not need to prove that you are smarter than the market. You need to study where capital is going, why it is going there, whether the move is early enough to matter, and whether the risk is controllable. That is the process. I would divide the process into a simple sequence. Start with the world, then look at the sectors. Only after that, look at the individual stocks. Most people reverse this sequence. They begin with a ticker, they hear a name, they see a chart, they read a headline, they want to know whether to buy it. That is backward. The better question is, what is the environment? What kind of businesses should benefit in that environment? Where is capital actually flowing? And among those areas, which companies are the leaders or the cleanest expressions of that flow? That is how you avoid random stock picking. You begin with the weather report, you ask where the world is energy tight, are minerals scarce? Is inflation a persistent issue? Is defense spending rising? Are governments trying to secure domestic supply chains? Are AI data centers increasing the demand for power, cooling, infrastructure, and physical inputs? Are geopolitical tensions pushing countries to rethink where essential resources come from? You do not need to become an expert in every field. You need a broad map. Then you study sectors. Which sectors are attracting money? Which ones are filling up with capital flows? Which ones have a tailwind from the environment rather than only a story? Which ones are improving because actual money is moving in, not because someone online is excited about them? Then you study the leaders inside those sectors. Only then do you look at the stocks. That order matters because it keeps you from becoming emotionally attached to a name. It forces you to ask whether the stock belongs to a larger movement or whether it is just a random idea. A single stock tip is dangerous. A stock idea without a framework is usually just a temptation. The first area that stands out in the source material is oil and gas machinery, services, and infrastructure. This is not the same thing as simply buying an oil producer and hoping the price of oil rises. It is closer to the old picks and shovels idea. During a gold rush, the people who made money were not always the miners. Sometimes the best position was held by the people selling the tools, the equipment, the transport, the services, and the infrastructure that allowed the miners to operate. Energy has its own version of that. There are companies that drill for oil and gas. Then there are companies that provide the equipment, compressors, tools, services, infrastructure, pipelines, terminals, and support systems that make production and transport possible. The source material focuses on the second group. That is important because the demand does not depend only on one company making one discovery. It depends on the need for energy infrastructure, drilling activity, LNG build-out, maintenance, security, and replacement. When the world needs more energy or when existing energy routes become less stable, the businesses supporting the system can become very important. The reasoning is straightforward. The world needs energy. AI needs a great deal of energy. Data centers need power. Industrial systems need power. Countries need secure supply. If geopolitical stress affects shipping routes or energy choke points, governments and companies become more sensitive to storage, pipelines, terminals, and domestic capacity. If energy prices stay high enough, companies have more reason to invest in production and infrastructure. This is the kind of environment where machinery and service companies can benefit. That does not mean every stock in the group is a good investment. It means the group deserves attention because the conditions may be creating a flow of capital into it. One name in that area is Baker Hughes, BKR. It is a large oil field services company. It sells the kinds of tools, technology, and services that sit behind oil and gas activity. In the source material, Baker Hughes is presented as a picks and shovels business for energy and LNG. The point is not that one should blindly buy it. The point is that it fits the sector logic. If energy infrastructure is expanding, if LNG terminals are being built, if companies are spending more on drilling and related systems, then a company that supports that infrastructure may be in the path of money flow. That is what I would watch. The chart behavior described in the source is also important. The idea is not to buy simply because a stock exists in the right sector. The idea is to watch for a period where the stock moves sideways, builds a base, and then breaks above a recent high with confirmation from the market. Many people think the best purchase is always the lowest possible price. That is not how professional risk thinking usually works. A lower price can be attractive, but it can also be early. Early can mean dead money. Early can mean the thesis has not yet been confirmed. Early can mean you are taking risk before the market has shown you that capital is actually pressing in your direction. Sometimes paying a slightly higher price after confirmation is more rational than trying to catch the exact low. This goes against the instinct of many investors because they have been taught to think only in terms of cheapness. But price is not the only issue. Probability matters, timing matters, confirmation matters, risk control matters. A stock that breaks out of a long sideways pattern may be showing that money is beginning to accumulate. If that move is supported by volume, it can suggest that larger buyers are involved. That does not make the outcome certain. Nothing in markets is certain, but it changes the probabilities. The source also mentions Newpark Resources, NPK, another smaller company connected to temporary worksite infrastructure for energy and construction projects. Because it is smaller, it can move differently and with more volatility. The source notes institutional ownership and analyst interest, but the important structural point is that it also belongs to the same infrastructure and energy support logic. Again, this is not a command to buy. It is an example of how to move from macro weather to sector tailwind to specific companies and then to price behavior. That is the discipline. The second area in the source material is critical minerals, mining, uranium, lithium, and related supply chains. At first glance, this can seem random. Mining and quarrying do not sound exciting to many people. They do not have the emotional glamour of artificial intelligence software or famous technology platforms. But markets often reward what the world needs, not what sounds exciting. The world is becoming more electric. Electric vehicles need lithium and battery materials. Renewable energy systems need storage because the sun does not shine at night and wind does not blow on command. The grid needs modernization. AI data centers require enormous amounts of power and cooling. Defense systems require materials. Countries do not want to be dependent on rivals for essential minerals. This creates a structural reason to study the sector. The source material points to government financing for domestic mineral supply chains that matters, because when governments decide that a resource is strategic, the demand is no longer just commercial. It becomes connected to national security, energy security, and industrial policy. When that happens, capital flows can change. One company mentioned is SQM, Sociedad Química y Minera de Chile, one of the major lithium producers. The source material connects it to lithium capacity, Chilean partnerships, and expansion plans. The stock chart described had a period of sideways movement and a potential breakout level above a prior high. The important lesson is not that SQM is automatically a winner. The lesson is that if lithium demand is increasing, if governments and industries need supply, and if the market begins to reward the stock after a long base, then it becomes a candidate for a disciplined watch list. Another company mentioned is Uranium Energy Corp, UEC. The uranium logic is tied to power demand. AI data centers need energy. Nuclear power is returning to the conversation because reliable baseload power matters when electricity demand rises. The source material says UEC has started production at a uranium mine in South Texas and points to the importance of domestic uranium supply that fits the broader idea of energy security. If a country does not want to depend on unstable or adversarial foreign sources for essential energy inputs, then domestic production becomes more valuable. Uranium is not simply a commodity story. It is connected to power reliability, policy, security, and infrastructure. But the timing described in the source is cautious. The stock had not yet fully confirmed the move. It had rallied, collapsed, and then started to show higher lows. That is a different setup from a confirmed breakout. It may deserve attention, but attention is not the same as action. That distinction is very important. A watch list is not a buy list. A watch list is where ideas go before they meet all the conditions. Many investors hurt themselves because they confuse interest with conviction. They see a theme, they like the story, they buy too early. Then they discover that a good story without timing and risk control can still lose money. The third mineral, related name mentioned, is Compass Minerals, CMP. described as another minerals and rare earth type of play. The source talks about a possible breakout level near a prior area. Again, the principle is the same. A sector thesis, a specific company, a base, and then a possible breakout. That sequence keeps the investor grounded. It prevents the emotional leap from story to purchase. The deeper message in the source material is that the stock market should be viewed like a chessboard, not like one simple line moving up or down. That image is useful. The news often says the market was up today or the market was down today. That is a very shallow way of seeing things. Inside the market, money is moving between fields on the chessboard. Some fields may be software, some may be uranium, some may be oil and gas services. Some may be gold miners, some may be defense, some may be healthcare, some may be insurance, some may be construction, some may be electronic components. Money does not disappear simply because the index is flat. It moves when money leaves one field and enters another. The relative opportunity changes. If you are only staring at the index, you miss the internal movement. If you study the board, you can see that one part may be weak while another is strong. That is what tactical allocation means. It is not magic, it is not guessing. It is not being smarter than everyone else. It is a disciplined attempt to see where capital is going and to align with it while controlling risk. The position may last a month, several months, or longer. The duration depends on whether the money keeps flowing. When the money leaves, the investor must be willing to leave too. That is another place where human weakness enters. People become attached, they buy a stock and then create an identity around it, they defend it, they argue for it, they search for evidence that confirms what they already own. This is dangerous because markets do not care about your attachment. A principle-based investor does not need a stock to be right forever. He needs a process that tells him when the probabilities are favorable and when they are no longer favorable. That is why risk management is not a small detail at the end. It is the center of the process. The source material gives a very important risk idea. Build positions so that the maximum loss from a specific idea is limited, often around 1% of the account, depending on the person and the strategy. The position may be larger than 1%, but the amount at risk is controlled by the distance to the exit and the size of the position. This is one of the most misunderstood ideas among ordinary investors. They think risk is the amount of money they put into a stock. That is incomplete. Risk is the amount they can lose if the thesis fails and they honor their exit plan. If they do not have an exit plan, the risk can become much larger than they imagined. This is why stock tips are dangerous. A ticker without position sizing is not a strategy. A chart without a stop or risk limit is not a strategy. A sector theme without discipline is not a strategy. You can be right about the big picture and still lose money. If your timing, sizing, and exits are wrong, that is why I would rather think in probabilities than predictions. Prediction says this will happen. Probability says under these conditions, this outcome has become more likely, but I still need to protect myself if I am wrong. That is a much healthier way to operate. Scaling into positions can also make sense. If you do not fully understand a new area or if the setup is still developing, there is no reason to put a large amount of capital into it all at once. A disciplined investor can build exposure as the evidence improves. He can avoid making one emotional decision that either wins big or hurts badly. The purpose of the framework is to replace impulse with process. Look at the macro weather, rank the sectors, find the leaders, watch the price behavior, wait for confirmation, size the position, define the risk, monitor whether the money is still flowing. That is the system. And systems matter because markets are designed to exploit people who do not have one. When people do not have a system, they chase what is loud, they buy after a move is obvious, they sell after fear becomes intense, they confuse popularity with strength, they confuse cheapness with opportunity, they confuse a story with a trade, they confuse being early with being smart. The market punishes these weaknesses repeatedly. It does so because human nature repeats. In every cycle, people want certainty. They want someone to tell them the 3 stocks that will make them rich. They want the answer without the process. But the real answer is the process. The tickers are examples. The framework is the value. That is why I would be careful with any title that promises a last big wealth opportunity of the decade. The phrase gets attention. It creates urgency. But the serious investor must translate the urgency into a process. The opportunity is not simply in a list of names. It is in understanding why money rotates where it is rotating and how to participate without gambling. There is a big difference between speculation and intelligent risk-taking. Speculation says, I heard this could go up. Intelligent risk-taking says, the environment supports this sector, money appears to be moving into it. A company in the sector is showing leadership, the chart is moving from base to breakout, and I know exactly how much I am willing to lose if I am wrong. That difference compounds over time. The investor who follows tips may win sometimes, but he becomes dependent on luck and other people's opinions. The investor who builds a framework may still lose sometimes, but he learns from each outcome and improves the machine. That is how you become less fragile. The market does not need to be easy for this framework to matter. In fact, it matters more when the market is difficult. In a simple liquidity boom, many things go up together. Process feels less necessary. But in a sideways or uneven market, selection matters much more. What you own can matter more than whether the index is up or down. This is the environment the source material is trying to describe. It is not enough to say, I own the market. You need to know what the market actually owns on your behalf. If the index is concentrated in a small group of mega-cap stocks, then your broad exposure is more concentrated than you may think. If money begins moving into energy, infrastructure, minerals, uranium, or other neglected sectors, then the broad index may not show you the opportunity early. If you wait until the story is obvious on mainstream media, you may be late. This does not mean abandon indexing. It means understand indexing. It does not mean chase every sector. It means study rotation. It does not mean buy every breakout. It means use confirmation and risk control. The serious investor holds two ideas at the same time. One idea is humility. You can be wrong. You will be wrong. The market can move against you. A thesis can fail. A chart can break down. A sector can reverse. A government policy can disappoint. A commodity trend can change. The other idea is discipline. Even though you can be wrong, you can still build a process that gives you favorable odds over many decisions. That is how professionals think. They do not need certainty. They need a repeatable edge and controlled downside. When I look at the sectors described in the source material, I see a common thread. They are tied to real-world constraints. Energy is a constraint. Power is a constraint. Minerals are a constraint. Infrastructure is a constraint. Domestic supply chains are a constraint. When the world runs into constraints, capital eventually moves toward the companies that help relieve them. That is the core idea. The public often notices the glamorous front end of a trend. They notice AI software, they notice electric vehicle brands, they notice headlines about growth. But behind every front-end story is a physical system. Power has to be generated, resources have to be mined, materials have to be processed, equipment has to be built, terminals, pipelines, facilities, and work sites have to operate. The back end of the trend can be less glamorous but very important. That is why picks and shovels deserve attention. If AI creates power demand, then energy infrastructure matters. If electrification creates mineral demand, then lithium, uranium, and other critical inputs matter. If geopolitics makes supply chains less reliable, then domestic sources and infrastructure matter. If governments respond with financing and policy support, the flow can become stronger. This is not a new law of markets. It is a repeated pattern. A big trend begins. Most people chase the obvious winners. Capital crowding makes the obvious winners expensive. Then the market begins to reward the less obvious suppliers, infrastructure providers, and enabling businesses. Eventually, the story becomes widely known, and then the opportunity changes again. That is the cycle. The investor's job is not to fall in love with any phase of it. The job is to see the phase clearly. If money is still flowing into mega-cap technology, there may be a way to participate. If money begins to rotate into energy services or critical minerals, there may be a way to participate. If the flows reverse, the process must adapt. Markets reward adaptation. They punish rigidity. This is also why I would not describe the index as evil or rigged in a moral sense. It is not moral. It is mechanical. The structure of market cap weighting creates certain effects. Passive flows create certain effects. Concentration creates certain risks. Understanding those effects helps you make better decisions. When the largest companies rise, they receive more weight. When they receive more weight, more passive money buys them. That can continue until valuation, earnings, rates, sentiment, or some other force interrupts the flywheel. If the interruption comes, the same concentration that helped can hurt. A person who understands that will not be shocked. A person who does not understand it may believe diversification failed, when in reality he never had the diversification he thought he had. The better approach is to know your exposures, know how much of your index exposure is concentrated in the largest names. Know whether you want that exposure, know whether you also want tactical exposure to sectors where money is moving. Know how much risk you are taking, know what would make you change your mind. This is not about being busy every day. The source material suggests that tracking sectors may take about an hour a week. The exact time will vary, but the principle is important. Many people spend 40, 50, or 60 hours a week earning money and almost no time thinking about how that money is managed. That is not a good trade. You do not need to become obsessed. You need a regular process. Review the weather, review the sectors, review the leading names, review the risk. Ask whether your thesis is still valid. Ask whether capital is still there. Ask whether your position size still makes sense. That is not glamorous, but it is how better decisions are made. The market is not one giant creature moving up and down as the evening news suggests. It is a complex system in which capital constantly searches for better risk. Adjusted returns. It flows toward perceived opportunity and away from perceived danger. It overreacts. It underreacts. It gets crowded. It abandons. It returns. It repeats. The investor who can see that is already ahead of the investor who only asks, did the SP go up today? But seeing the system is only the beginning. The harder part is controlling yourself when a stock is breaking out. The instinct may be to chase too much. When a stock pulls back, the instinct may be to panic. When a thesis is popular, the instinct may be to size too large. When an idea is early, the instinct may be to buy before confirmation. When an idea fails, the instinct may be to rationalize. That is why principles matter. A principle is a rule you create before emotion arrives. For example, I will not buy a stock simply because I like the story. I will not risk more than a defined amount on one idea. I will not confuse a watch list with an action list. I will not assume a sector tailwind protects me from a bad entry. I will not hold a position just because I want to be right. I will follow the money, but I will also respect when the money leaves. Those principles are simple. Following them is not always easy, but it is necessary. If you look again at the structure of the opportunity described in the source material, it is really a lesson in how markets shift from one regime to another. In the old regime, liquidity, low rates, and enthusiasm lifted many assets. In the current regime, scarcity, rates, policy, energy security, and supply chains matter more in one regime. A simple index approach could feel like genius. In another regime, it can leave you concentrated in yesterday's winners while tomorrow's flows begin elsewhere. That does not mean the famous companies stop being great businesses. Some of them may remain extraordinary. But great businesses can still have periods of poor stock performance if the money is rotating away or if expectations have become too high. The stock market is not just a voting machine and not just a weighing machine. In the short and medium term, it is also a flow machine. Money moving in creates pressure. Money moving out removes pressure. Understanding that helps explain why sectors can move even when the broader market seems confusing. The energy services thesis is a flow thesis tied to energy demand, LNG infrastructure, geopolitical stress, and the need for equipment and support systems. The critical minerals thesis is a flow thesis tied to electrification, batteries, grid modernization, defense, AI, power demand, and domestic supply chains. The index concentration thesis is a flow thesis tied to passive investing and market cap weighting. All of these are connected by one idea: capital follows pressure. When pressure builds in the real world, eventually it can show up in markets, but the timing is never guaranteed. That is why the chart setup matters. Sideways movement can represent a period where the market is absorbing information. A breakout can suggest that buyers are beginning to take control. Higher lows can suggest selling pressure is weakening. Volume can help confirm that the move is not just noise. None of these signals are perfect. They do not need to be perfect. They are pieces of evidence. A good investor builds a mosaic. Macro gives one piece, sector flow gives another, company leadership gives another, price structure gives another, risk management gives the final protection. When the pieces line up, you may have a trade or investment worth considering. When they do not, you wait. Waiting is an underrated skill. Many people feel that if they understand a theme, they must act immediately. That is impatience. The market will always offer opportunities. The goal is not to catch every move. The goal is to avoid unnecessary mistakes and take the opportunities where the odds are favorable. The source material repeatedly emphasizes that the viewer must come to his own conclusion. That is right. No one should treat a ticker as a command. The responsible way to use ideas like BKR, NPK, SQM, UEC, or CMP is to place them inside a process. Why does this company fit the sector? Is the sector receiving money? Is the company a leader or a useful expression of the theme? Is the chart confirming? What is the entry? What is the risk? What invalidates the thesis? How much can I lose? What will I do if I am wrong? Those questions turn a stock idea into a decision process. Without them, it is just entertainment. And a lot of financial content is entertainment pretending to be strategy. A serious person should be careful about that. The best part of the framework is that it does not require you to be a genius. You do not need to know every detail about every company. You do not need to predict the next central bank meeting perfectly. You do not need to understand every commodity market at a professional level. You need to ask better questions consistently. Where is the weather changing? Which sectors benefit? Where is money flowing? Which companies are leading? Has the price confirmed? What is the risk? That is enough to make you much more disciplined than the person who simply reacts to headlines. The quiet machine will keep moving money. It will move whether you see it or not. It will move through index concentration. It will move through passive flows. It will move through sector rotation. It will move through energy, minerals, technology, defense, healthcare, construction, and whatever the next environment demands. You can either watch the surface and wonder why certain things happen, or you can study the flows and begin to understand the mechanism. I would rather understand the mechanism that does not make the future certain. It makes the future more navigable. If the broad index rises because a few mega-cap companies carry it, understand that. If the index goes sideways while energy service stocks move, understand that. If critical minerals begin to form bases and break out, understand that. If the money leaves those areas, understand that too. The objective is not loyalty to a sector. The objective is alignment with reality. Reality changes. So must the portfolio, that is the principle behind following the money. Do not follow noise. Do not follow hype. Do not follow fear. Do not follow a stock tip without a system. Follow the actual movement of capital and do it with humility, sizing, patience, and define risk in a world where the largest stocks have become a huge part of the index, where passive flows keep reinforcing concentration, and where new pressures are building in energy and minerals. The investor who understands rotation has an advantage, not because he knows the future, because he knows what to watch. That is what matters now. The market is not simply offering one broad opportunity, it is offering a map. Some parts of the map are crowded, some parts are being abandoned, some parts are quietly attracting money before the crowd fully understands why. The task is to read the map, then act only when the evidence, the price, and the risk line up. That is how I would think about these opportunities. Not as lottery tickets, not as promises, not as certainty, but as a disciplined way to participate in the parts of the market where capital may be rotating next. And if there is one idea to keep in your head, it is this. The market may look flat on the surface, but underneath the surface, money is always moving. Your job is to stop staring only at the surface, follow the money.